If you recall, on Friday, before I left, I was a wee bit nervous with the status of the market, and I had fear and trembling in my voice, which is not like me. Well, apparently that total trader's instinct, for lack of a better word, really did pay if you stayed short from that Friday into Monday.
This short clip is presented by Club. Club provides access to Samantha LaDuc and her team of professional macro and micro traders, analysts, and educators. Club is ideal for active traders, investors, and institutions who want Samantha's best-of-breed market timing calls across all asset classes and timeframes like chase, swing, and trend. Get the trade before it happens. Sign up Club now and get full access to daily live trading room with Samantha LaDuc, Slack trading desk with detailed analysis and trades, custom trade support when you need it, and much more. For more information, visit www.LaDucTrading.com/club.
Now, this is a snapback rally, and we have still worries. And I think you already kind of know that and feel that, but you're kind of wondering, all right, so I did, just so you know, this was Friday. I closed my trading rooms and I'm like, it's just not feel good. I think we have a global margin call. And then you know what happened with the yen carry trade on Monday, but it is not. And I know that the news and Twitter and wherever else you might get your data was just absolutely overwhelmed with all things yen carry trade unwinding. That which I've been talking about since November of last year. But it was everything. It was the SOM rule had triggered. 4.3% was above the 4.2% threshold. And I said, when this does trigger, it will instantly de-risk, basically force de-risking in portfolios, those who actually manage money, just on the very fact that it hit that level. Even though, and I remember on that morning, I'm like, but there was actually some green shoots in there. It was new entrants coming into the market, not necessarily the recession warning that it normally is. It didn't matter. It didn't matter. I warned that when we hit that threshold, we will have volatility, period. And then you have that VIX backwardation, which is where the 3-month in the spot basically invert and they go below zero. Negative dealer gamma was already in that regime. So we had already started selling off. We had a Volmageddon 2.0 risk. Now remember, I wrote this originally way back before all this drama. Remember in July 9th, we did an edge roundup for a macro roundup for our edge clients where I said, I can see reasons to hedge to SPX 4300. We're not there yet. So 5,700 to 5,100, that's a hell of a nice move, but that's not 4,300. This is literally the November 1st Fed pause and Yellen Yahtzee. I still think we are going there. Moving on, CTA's forced selling, and of course, no stock buybacks mitigate that risk of CTA's forced selling. Concentration risk de-risking, and I have that chart to update you on RSP to SPY. The yen carry trade got all the attention. It got all the attention, but it's only one carry trade, basis trade, which is that huge, I think 3-year long trade right now where they are shorting treasuries and bidding up NASDAQ. It is an unwind unrelated to yen carry trade. It's all part of it. It's notes and bonds in the treasury futures market. And then, of course, yields crashing. And remember, I said 4.2, we're going to go to 4.8. 4.0. If we break that, we can overshoot to 3.9. 3.8 is massive monthly support. We hit it. And gold as a collateral risk was the only thing that had not happened yet. So we had literally, and by the way, this had none of my top 10 even had to do with Iran or Israel. Nothing. The point is, I did see high yield OAS credit spreads about to blow out. And oil weakness can accelerate lower. I am right now still in the camp that we're going to have high yield credit spreads move higher. I'll show you that chart. And I'm still in the camp that we're going to have oil weakness come in next. So we did have entirety of the yield curve collapse. Those charts I'm going to look at this morning are probably going to catch my breath, but I'm just updating you that this was more than just the yen carry trade. That's all I wanted to say. So safety has been playing, and even though I said we could get a hell of a snapback rally Don't assume Nvidia and Apple will save us. So fast forward, I got really nervous. This was Friday afternoon. I'm like, nope. You heard it in my voice. I didn't like the feel of the market at all. And so I did a follow-up at the end of the day, and I said, forced selling equals forced cutting, which means the whole narrative is going to move very, very quickly into Fed rate cuts. We need them help. Jeremy Siegel was on saying we need an emergency 75 basis point cut. Point is, I really did see that we were going to hit well before that Monday, that we were going to hit the 53.76 and QQQ 449. On Friday, we opened up below. Remember that? And so this was literally my call. VIX to 20, overshoot to 21.33, and then SPX here and here. Now, VIX, oh my God, it went above 21.33, and I said something's really broken. It ended up going to 65 pre-market on Monday morning. So the regular print is really only like 38, but the pre-market was scary. We did have a liquidation risk, and that was what I was absolutely worried about. The VIX we had been tracking. Remember, I like the volatility, but more importantly, we also had VXN, the volatility of NASDAQ, caught that really, really early. Long story short, this was one of those, market is just telling the Fed they are so behind the curve. We're going to start to sell off. There's actually a liquidation risk. So I had the VIX in backwardation as a timing tool. Gold did not careen lower, but miners did. I've got an update intermarket chart for that. Yen carry trade, by the way, has been going on for 13 years. Big money has been borrowing yen, very low interest rates, converting it to US dollars, buying all kinds of leveraged assets, Bitcoin, NASDAQ, you name it. Namely US big mega cap tech. We already saw the dollar yen. As soon as it broke 152, I warned. I said, if this goes back inside 152 yearly support, we're going to have a cascade in concentration risk, meaning semis and NASDAQ 100, MAG 7, and we did. And I mean, this careened all the way down to 141. So it was a very, very synchronized trade. And then, of course, it bounced back up. The Nikkei bounced 10%. After crashing on Monday, and the stock market looks like, it's put in the low, we're going to go make a new high. Okay, well, I have to go and dissect that. Are we really? Because I was expecting that we would have one more high, but I'm not seeing that right now. And so that's why I want to go over some of my intermarket. When this morning session is over, Bitcoin, by the way, fell from 70,000 down to 50,000 and then had a big old bounce. But the point is, we had reflexive bounces where those who were positioned for downside could monetize big way. And this poem that I wrote you back on July 25th really, really did work out. Credit spreads compressed, not anymore. Volatility suppressed, not anymore. Currency depressed, still is. From policy interference expressed. We have not gotten Jackson Hole's speech out of the way to see if Fed is going to stay put, or they are going to intonate a 25 or 50 basis point cut. I think they will. That's personally what I've been betting on. And then we still have quantitative Yellen support monetary currency easing, which is liquidity producing versus seizing. So we still have lots of liquidity out there. The problem is this was triggered by deflation, that CPI negative month over month print, very important, the non-farm payroll elevation. And all of this was already in play with de-risking of concentration, no question about it. And now yen carry trade unwind is deleveraging. So when I wrote this on July 25th, bonds were already sold. Equities are now way too bold. And you know what happened? TLT went from 85 to 100, which was the price target. And tons of equities are just on the floor and had some very large snapback reflexive bounces. But this is why I wrote this up on Friday, because I know I've written about this a lot since November of 2023, but it all kind of coalesced in one big swoop on Monday morning. And I was absolutely worried about liquidation. And I wanted you to be positioned for that, even if it sounded a little quirky. So then fast forward, and I did have these charts that I showed you. And by the way, this absolutely came all the way up here and then came back down. So credit spreads, high yield did push higher and then came back down. I still think they have a very strong potential for getting back above that 4 level, by the way. VIX absolutely went into backwardation, and it triggered a -5 at some point and then snapped back, which is what it typically does. So this VIX right here, this is on 8.2. It went all the way up here to this 36. So it went all the way back up to basically the prior, this is, you can't see it, it's the 3-month. It's not VIX, it's the 3-month down here. I have updated those because those are the ones that were most impressive to me. And this is why, see that backwardation? Why we had a massive reversal in VIX. But guess what? I don't think it's done. I don't think VIX is done. So I'll be writing about that a little bit more. But then on Monday, thought that this was still very viable big picture for lower. But there's no question we hit key levels. The 10-year hit my 3.8%, which is monthly. It actually overshot it. That is really dangerous, by the way. In other words, the likelihood of us moving below 3.8%, even though we closed above 3.8% and started to move a little bit higher, it is still a big risk in the future of us breaking the 10-year yield at 3.8%, just FYI. TLT went firmly into 100. That had been price target. NVIDIA went firmly, not into, but through 96. That had been price target. Remember Tesla? I said I would not be surprised if we see 200 by the end of the month. That worked. Microsoft 390. That worked. Apple 210, it overshot. And Bitcoin crashed. Yes, it's good enough to call a bounce, and then we did have one last week. Obviously, if you looked, I had made a joke on Twitter because where we closed on Friday of the day I left and where we closed on Friday of late, just a few days ago on the 9th, it's even. So all we did was bounce back up to even. Looks like nothing happened. But I don't feel that way. I think once we have a liquidation event, it makes the market participants a lot more nervous, looking ahead and how to protect, because in many cases, they were not. We also had a whole bunch of drama happening in the option derivative market where the company Blue Ocean literally canceled trades, reversed them between, I don't know, it was like 1:30 and 3 o'clock in the morning. So folks that saw the blood wanted to pick up some really cheap prices in Apple and NVIDIA and such, and those trades were canceled. So they have now migrated, or they are migrating this week. So your options market was a mess Monday morning. That's the risk. When I said I'm worried about liquidation risk, that's what I mean. You can get in, but you can't get out. It's like the Hotel California. Long story short, this was definitely an options nightmare as it related to derivatives trying to get in or get out. And that is, by the way, a whole week of low volatility in the options market because of their migration to a new platform. I forget what it's called, MEMX, MEMX. So just really tread lightly this week. Literally, we have 5 option market makers at the core, and they were all down. So it was really it was a cluster pre-market on Monday. Market is not safe when that happens. So that's why I was a little bit weird on Friday afternoon and why I wrote this. Be careful, you've got a liquidation potential, and we did have it on Monday. No question about it. The options market, big picture, there was still some very big puts that were not convinced that this drama was over, even if it was isolated to the VIX. It was very much a cross-asset type of liquidation, but the volatility or the VAR shock was very similar to COVID or great financial crisis. So it had an overreaction. And honestly, I don't think those short sellers have finished. I really don't. I still think VIX is going to stay elevated. Global margin call means this: forced selling, which we saw, equals forced rate cuts, which we have not seen. And unfortunately, it equals more forced deflation, and that means forced liquidation. I don't think this is done. That's it. Markets and oil, I still think we have issues. Long story short, I just don't think the rise of carry is not a one and done at all. This is globally, it's been going on for 13 years with US and Japan carry trade, and I don't think it's going to be done. Even after the Fed does their big old rate cut, I don't think it's going to be done. Just we'll see what happens. But in any case, in the meantime, looking for credit spreads to continue, looking for VIX to continue, and that's what we're going to talk about in a little bit more detail. But I do have, let's just say, fresh eyes. So I know this is going to be really quick, and then we'll go into the market itself and I'll show all kinds of charts. But do you remember when I said it looks to me like the 10-year is going to fall and it has some levels? These were gaps relative to Apple. Anyway, long story short, it has filled 1, 2, 3, 4, 5 gaps. And this is actually the wrong color. And it has one more up here. So when I say I'm actually worried that we're going to have the narrative turn from inflation to deflation into the rest of the year, and I know I've talked about that in the S&P Global Intelligence interview and the podcast that I did with Jason Burback a few weeks ago, I still see that potential of yields even breaking now my 3.8%. But that's a solid place to bounce. And that's what we have done. Some of these are intermarket tells that I know are going to be a little confusing, but just to kind of show you, some of this stuff literally landed right on support. And we had this massive bounce that you can see everywhere. But one thing that does not look supported, by the way, is yields coming back down and a big old inverse head and shoulder for my US government debt ratio with yields. This looks higher, yields look lower. But here's one thing, I'm still looking for oil. Big picture. If we lose oil right here, this is very, very important, very important, okay? You know I've been watching this for a while, and this is totally separate from Robert's analysis under his channel. His channel, which is very focused on the physical oil and how they hedge the speculators who are buying and selling, et cetera, et cetera. But this is a technical assessment that I have been watching for a while now. This is on a monthly. And when it got to 65, I said it wouldn't surprise me if it doubles within a year, and it did. So now we're right back on this very strong monthly trend line. We've been testing, trying to break it. And I know there are all kinds of reasons why it shouldn't break, from escalation risk to supply disruption, war escalation risk to supply disruptions to demand support. But I think we're going to get a demand dump. And I think this is going to roll over. I think it's going to break zero. And when this cascades lower, when oil breaks down and heads back into that 65 area, I don't think it's going to hold. Now, this is for next year. This is for end of year, but something's up with this. And so I know I have some trader instinct, and then I have some technical, and then I have some macro and fundamental read, but I'm just letting you know the most important chart that I see right now is oil has not rolled over, gold has not rolled over. If they do, those are massive collateral trades. They will further the sell-off. That's it. Know your time frame, but gold, if it sells off as a collateral trade, oil as it sells off, oh my God, this is such a hedge trade for everything, for currencies, for countries. Don't be a hero and think, oh, we're gonna go back up to NVIDIA, 138, 140. Don't assume that. If oil gives up, the market gives up, period. If gold gives up as a collateral trade, which I don't expect it to be a big drama, but I'm just saying, if it does, that's when we can also trigger more volatility. And then real quick, remember that semi also to monthly? This is key. I've been talking about this when we get here and turn. Well, semis definitely turned, and I would say they have some more to go. And then big picture, again, this is on a monthly. We've definitely softened and rolled over. And the same thing with tech. Remember, buy tech inside the channel, short tech at channel breakdown. We're just, and this is on a monthly, and this is NASDAQ composite to SPX. We're breaking that. And interestingly enough, I would also have to say, we tagged perfectly. We tagged this, you can't see it, but it was a monthly resistance level. And I did happen to take a picture of it at the time. Obviously, today's the 12th, middle of August, but we literally tagged that and came right back in. So the selling has been very dramatic in the past month since this reached resistance and came back in, and semis have also rolled over. And I don't see that as done. Big picture, de-risking, semi-weakness, and oil has not rolled over. And that's the big risk that I'm watching right now, or I should say next. Remember, credit spreads blowing out and NASDAQ coming back down. We got saved. So these are the ones that I'm looking at. We definitely had liquidation. This was that backwardation of VIX, etc. So I can see a lot of charts that are doing damage control. They're trying to get back up, excite the bulls. But for right now, I would say just know what you own if we lose oil.
Subscribe to LaDucTrading YouTube channel for more live trading room recap videos and other content.